Welcome to the deep dive. Today, we're tackling something that might be flying under your radar, but honestly holds serious potential if you're looking at commercial real estate.
Especially right here in Indianapolis.
Exactly. Regulation 506B.
Hmm.
Now, for those of you who've maybe been tracking the Indy investment scene or perhaps sent in some research, you've probably bumped into private real estate deals.
Hmm.
So our goal today, our mission really, is to unpack how 506B works and, crucially, why it could be such a powerful tool in this specific market.
Yeah, that's the plan. You've shared some great material, and that guide by Cara Conde offers a particularly sharp focus on Indianapolis.
Right.
We want to go beyond just like the dictionary definition of 506B and really explore its real-world impact here,
Yeah.
the opportunities, the nuances, especially drawing on Cara's insights.
Absolutely. Her take seems to be that 506B isn't just some regulatory footnote. It's a key driver for building wealth in private commercial real estate deals here in Indy.
It really can be.
So let's just get straight to it. What exactly is Regulation 506B? Why should folks listening care?
Okay, so at its core, Regulation 506B, it's an exemption. It sits under the SEC's Regulation D.
Okay, Reg D.
Yeah, think of Reg D as kind of the rule book that lets people, like real estate developers, raise money privately without doing the full public offering registration thing.
Ah, so it streamlines things, avoids some major hurdles.
Precisely. And 506B is one of the main pathways within that rule book for raising private capital.
Gotcha. So who gets to invest under this 506B pathway?
Right, that's crucial. Two main categories. First up, accredited investors.
Okay, we hear that term a lot. What's the actual definition nailed down?
It's pretty specific. You qualify if your individual income was over $200,000 for the last 2 years.
200 grand. Okay.
Or if your joint income with a spouse was over $300,000 for those same 2 years. And importantly, you expect that level to continue.
Right. Or there's the net worth test.
Exactly. The other way is having a net worth of at least $1 million. That can be individual or joint. But, and this is key, it excludes the value of your primary residence.
Okay. So think about Indianapolis. We might be talking successful tech folks, maybe surgeons, established business owners.
Yep. Cara Conde's guide definitely points to those types of profiles active in the Indy market. Then there's the second group, sophisticated, non-accredited investors.
Sophisticated, non-accredited. Okay, that sounds a bit more, I don't know, accessible. You don't have to be a millionaire.
That's true. You don't need the same income or net worth. But there's a catch. You can only have up to 35 of these investors in any single 506B offering.
Only 35. And what makes them sophisticated?
Well, that's the key word, isn't it? They need to have enough financial savvy, enough business knowledge to understand the investment and evaluate the risks properly.
So like maybe an experienced CPA.
Hmm.
Or a commercial real estate broker who really knows the market.
Exactly those types. People who might not hit the accredited numbers, but definitely understand the complexities of these kinds of deals. It's about financial literacy, not just dollars.
Right. So it's not just, can you write the check? It's, do you understand what you're investing in?
Precisely. And this leads to a really, really critical piece. The no general solicitation rule.
Okay. No general solicitation. What does that mean in practice? No ads.
Basically, yeah, you cannot publicly advertise these investment opportunities, no mass emails to strangers, no public webinars open to anyone, no big social media blasts.
Wow.
The sponsor, the person raising the money, must have a pre-existing substantive relationship with every single investor they approach.
Pre-existing and substantive. So you can't just meet someone at a conference and pitch them the next day.
Generally, no. It implies a deeper connection. Like Cara Conde's guide mentions, prior business dealings, real personal rapport, maybe a warm introduction from a trusted mutual contact.
So it really doubles down on the importance of your network. It's about trust and established connections.
Absolutely. That relationship needs to be solid before the investment opportunity is even discussed. It's a massive difference from, say, Regulation 506C, which does allow advertising, but only to accredited investors.
Got it. So 506B is much more about those private, trusted circles. Okay, what about the deal size? Is there a limit on how much money you can actually raise using 506B?
And that's one of its biggest strengths, actually. There's no federal limit on the amount of capital you can raise under 506B.
No limit, really.
No unlimited capital raise potential, which means it's incredibly flexible. It can work for smaller projects, maybe a retail strip rehab, or massive ones like, a huge mixed-use development downtown Indianapolis. And Cara Conde points this out, too.
Yeah, that's significant. Offers a lot of scalability. Okay, what about transparency? What info do investors actually get? Are there disclosure rules?
Yes, definitely. That falls under disclosure obligations, and
Yeah.
what you have to provide differs depending on who you're providing it to.
Between accredited and non-accredited.
Exactly. For accredited investors, the requirements are generally lighter. They typically get a pitch deck, outlines the project, the terms, the team, maybe the subscription agreement. The assumption is they have the background to assess it.
Okay, more streamlined for them.
Yeah.
Makes sense.
But for those non-accredited investors, the sophisticated ones, you owe them much more comprehensive information.
How much more?
Significantly more. Cara Conde's guide mentions it can be similar to what you'd see in a registered offering, almost like a mini prospectus. Detailed financial statements, really thorough risk disclosures, the full operating plans, the chance to ask questions.
Yeah, okay, so real safeguards there for the non-accredited folks.
It ensures they have everything needed to make an informed decision, given they don't meet the accredited wealth thresholds.
Makes sense. So the deal gets funded, money comes in.
Yeah.
What happens next? Any paperwork with the regulators?
Yep, there are post-deal filings.
Mm.
The main one is you have to file a Form D with the SEC. Yeah, electronically within 15 days of the very first sale of the securities in the offering. It's basically a notice filing. Tells the SEC, hey, we did this private offering, gives some basic details about the deal, the issuers, but not super detailed investor info publicly.
Okay, a notification. What about state rules?
Good question. You also have to comply with state blue sky laws. These are the state-level securities regulations. Each state is different.
Right.
Now, Cara Conde mentions Indiana's process is relatively streamlined for these types of filings, which is helpful, but you still absolutely have to check the boxes and make the required state filings, often alongside the federal Form D.
So federal SEC filing, state blue sky compliance.
Got it. Seems like there's a bit of history here, too, right? Reg D came about in '82.
Yeah, Regulation D itself dates back to 1982. 506B, as we know it, really crystallized more after the JOBS Act in 2012, which aimed to, ease capital formation while still protecting investors. It's been an evolution.
Okay, let's make this concrete. Could you walk us through a quick hypothetical Indianapolis example based on what Cara Conde describes? Sure, let's imagine a local developer spots an opportunity, say a $25 million industrial warehouse project near the Indianapolis airport. Big logistics demand, right?
Yeah, huge growth area there.
So they need to raise, say, $10 million in equity. They tap into their network. Maybe they know 20 local execs, doctors, business owners who are accredited investors. They reach out privately, explain the deal, the projections. Let's say they each commit $400,000. That's $8 million.
Okay, still need $2 million more.
Right. So now they approach maybe 10 sophisticated non-accredited investors from their closer circle. Could be like a supply chain consultant who deeply understands the tenant potential, or a savvy accountant they've worked with, people they have that pre-existing relationship with. They each invest $200,000.
And these folks get the more detailed disclosure package.
Exactly. They get the full rundown. Once the first check clears, maybe from an accredited investor, the developer files Form D with the SEC within 15 days, and they handle the Indiana state filings. No public ads, just leveraging their network. Project gets funded.
That paints a really clear picture. Thanks. So now let's zoom in specifically on Indy. Why does Cara Conde's guide position 506B as such a key player, such a driver in the Indianapolis commercial real estate scene? What's the specific connection?
Well, Indianapolis has this really interesting dynamic. It's a solid, growing commercial real estate market, right? But it often operates maybe more than some giant coastal cities within established local networks. Relationships matter here.
Okay.
And 506B, with its emphasis on pre-existing relationships and no public advertising, just fits that culture really well. It facilitates deals like syndications.
Where multiple investors pool money.
Exactly. Pooling money for bigger properties they couldn't buy alone. Or joint ventures between, say, a developer and a few private investors. 506B provides the framework to do that privately, efficiently within those networks.
That makes a lot of sense for a market like Indy. And Cara Conde actually gives a detailed hypothetical, doesn't she, about a Class B office building.
She does. A $15 million Class B office deal in Keystone Crossing. Good example.
Yeah, walk us through that one. How would 506B work there?
Okay, so picture this group. They find an office building, maybe 80% leased. Tenants are a mix, tech startups, law firms. It's okay, but needs work.
A value add play.
Exactly. The plan is buy it, renovate the common areas, maybe add some amenities, push the rents up over time, and then sell it in, say, 5 years. Classic value add.
Right. So how do they fund the equity needed?
Using 506B. They might target, say, 20 accredited investors they know from the local business scene, maybe successful entrepreneurs, executives from larger indie companies. Perhaps they each put in $600,000. That's $12 million.
Okay, getting close.
Then they bring in maybe 5 sophisticated non-accredited investors. Could be someone who used to manage similar buildings, knows the submarket inside out, or maybe a small business consultant who really understands the tenant base. They each invest, say, $300,000. That gets them their $15 million equity target.
And the pitching process, still private.
Totally private. Small group meetings, maybe some one-on-one Zoom calls, private dinners, definitely no public seminars.
And the paperwork difference again?
Yep. The accredited folks get the streamlined package. The 5 sophisticated investors get the thick binder, basically. All the financials, detailed risk factors, the full business plan.
Got it. Then the deal closes, renovations start, maybe cash flow distributions begin after stabilization.
That's the idea. It really shows how 506B enables these kinds of local, network-driven, value-add plays that are pretty common in Indianapolis.
And Cara Conde points out it's not just office buildings, right? She lists a whole range of property types in Indy funded this way.
Oh, yeah, absolutely. It's across the board. Multifamily is huge. She mentions like an $18 million, 120-unit complex out in Fishers. Good cap rate, attracting young professionals. That's a prime 506B target.
Makes sense. What else?
Retail, too. Maybe a $10 million shopping plaza in Noblesville, anchored by a Kroger. Stable, family-oriented area attracts certain investors. Industrial, we talked about that, a $25 million warehouse near I-465. Capitalizing on e-commerce, maybe promising investors solid 8% type yields.
And mixed use is big now, too.
Definitely. She gives an example of a $35 million project, maybe on Mass Ave. Retail downstairs, offices above, maybe 60 apartments or lofts. Very common structure these days. And even Class A downtown office towers, maybe $20 million, 90% leased to tech firms, all potentially funded via 506B syndications.
So it really touches almost every part of the Indianapolis commercial real estate landscape.
Pretty much. It's a versatile tool.
Okay, so summing up the advantages of using 506B in Indianapolis, based on Cara Conde's insights, what are the big ones?
Well, privacy is a major one, she highlights. These deals stay largely off the public radar, which appeals to a lot of sponsors and investors here.
Keeps things discreet.
Right. Then there's the inclusivity factor, allowing those up to 35 sophisticated non-accredited investors. It broadens the pool beyond just the ultra-wealthy, taps into local expertise.
Opens the door a bit wider.
Yeah. Cost efficiency is another big plus. Avoiding a full-blown public registration saves a ton of time, legal fees, accounting costs, huge savings.
Less red tape, less expense.
And we already mentioned the boundless scale, the unlimited raise potential, makes it adaptable for all sorts of indie projects, big or small.
Okay, those are compelling benefits. But it can't all be easy street.
Yeah.
What are the real challenges or difficulties Cara Conde points out when using 506B, especially here?
Oh, definitely challenges. Building and maintaining those required investor relationships, that takes serious time and effort. It's not transactional, it's relational. Lots of coffee chats, networking, building trust over time.
Right, you can't just conjure up a substantive relationship overnight.
Exactly. And compliance is absolutely critical. One slip up, like an accidental public advertisement or bringing in too many non-accredited investors, could completely blow the exemption. Very serious consequences.
High stakes on getting the rules right.
For sure. Illiquidity is another big one. This isn't like buying stocks you can sell tomorrow. You're typically locked into these deals for, 5, 7, maybe 10 years. Long-term commitment. Absolutely. And finally, the onus is really on the investor to do their homework. Due diligence is key. Because it's a private deal, you don't have all the same regulatory oversight as a public offering. You or your advisors need to vet the deal and the sponsor thoroughly.
Investor beware, essentially. Do your own research.
Very much so.
Okay, so putting it all together, why does Indianapolis seem like such fertile ground for these 506B deals? What is it about the Indy market specifically that makes this framework, according to Cara Conde, so effective?
Well, several things kind of converge.
Yeah.
First, the Indianapolis economy itself. It's got diverse growth drivers, right? Tech is booming with Salesforce and others. Logistics is huge with FedEx's hub, life sciences, advanced manufacturing, even sports tourism. These create demand for different types of commercial property.
So a healthy underlying economy.
Yeah, and that's led to a surge in property development and investment. You see warehouse construction out in Plainfield, office revitalization downtown, retail expanding in places like Carmel. Cara Conde mentions like $1 billion in deals just last year. There's activity.
A lot of velocity in the market.
Right. And critically, compared to, say, the coasts, Indianapolis generally offers more attractive pricing. Lower cost per square foot, potentially higher yields. It's more affordable to do deals here.
Better bang for your buck, potentially.
Could be. But beyond just the economics, Cara Conde also really emphasizes the culture of Indianapolis.
How so?
It's a mid-tier city, right? Large enough to have opportunities, but small enough where relationships and local networks still really matter. People know each other. Business often gets done based on reputation and personal connections. Think about places like the Columbia Club she mentions, where people connect.
That everyone knows everyone kind of feel, to an extent.
Yeah, maybe not literally everyone, but there's a strong relational fabric, and that aligns perfectly with 506B's reliance on pre-existing substantive relationships. It just fits the way business often gets done here.
That makes sense. The structure fits the local business culture.
Exactly, and she gives that real-world example, right? The $12 million mixed-use project near the Cultural Trail.
Yeah, tell us about that one again. How did 506B play out there?
So this was a project Cara Conde herself apparently orchestrated. Mixed-use, retail, condos, prime location near the trail. She needed to raise equity.
Okay.
So she leveraged her network. She identified, I think it was 18 accredited investors and 5 sophisticated non-accredited investors who she knew, people interested in that kind of urban redevelopment project.
All people she had prior relationships with.
Correct. She held a private event, maybe a tasting or something exclusive, laid out the plans, the projected returns, like a 7% cash flow target, 16% IRR, the whole vision.
So a very targeted private pitch.
Precisely. And it worked. She raised the capital needed through that private 506B offering. It really showcases how someone with deep local knowledge and a strong network, like Cara Conde seems to have, can effectively use 506B in growth areas she identifies, like Fountain Square or Westfield.
That's a great illustration. Okay, so let's pivot to the listener. Someone tuning in, maybe they're thinking about investing in an Indy 506B deal, or maybe even structuring one as a sponsor. What are the key takeaways, the actionable steps Cara Conde emphasizes for mastering this?
Right. For the listener wanting to engage, first, she says, get really clear on your own investment goals. Are you after cash flow primarily?
Yeah.
Long-term appreciation? Tax benefits? What's your priority?
Know thyself, investor.
Pretty much. Second, vet the sponsor relentlessly. This is huge. Look at their track record in Indianapolis. Have they done similar deals before? Any defaults? Talk to people who've invested with them, audit their claims.
Due diligence on the people behind the deal.
Absolutely critical. Third, build your network within the Indianapolis real estate scene. Go to the events like IRM or BOMA meetings she might mention. Connect with brokers, lenders, attorneys, experienced investors like Cara Conde. Information flows through networks.
Get plugged into the local ecosystem.
You have to. Fourth, when you see a deal, analyze it critically. Don't just trust the sponsor's numbers. Understand the key metrics for Indianapolis. What are typical cap rates? She suggests 6-8% might be normal. What's the debt coverage ratio look like? Needs to be above 1.25 usually. Cash-on-cash return expectations. Maybe 8-10%.
Know the local benchmarks.
Yeah, and look at market stats. What's citywide vacancy? Maybe 4% currently. What's realistic rent growth? Perhaps 3% annually. What are comparable properties actually selling for per square foot downtown or in the relevant submarket? 250 SWIT is a number she might throw out for downtown. Dig into the specifics.
Really got to crunch the numbers specific to Indy.
No substitute for it. And finally, assemble your own A-team. You need a good securities lawyer who deeply understands 506B. You need a CPA who gets real estate taxation. And you probably need a knowledgeable local commercial real estate agent or broker on your side. Don't go it alone.
Build your support system. Makes sense. What about more advanced tactics? Does Cara Conde mention anything beyond the fundamentals?
She does. She talks about strategic diversification, not putting all your eggs in one basket, maybe investing across different property types that are strong in Indy, like industrial and multifamily.
Spread the risk.
Right. She also stresses having a clear exit strategy defined upfront. How will investors get their capital back? A planned sale in year 5. A refinance clause. Needs to be clear.
Plan the exit from the beginning.
Absolutely. Also targeting emerging submarkets within Indianapolis. Maybe areas like Irvington undergoing rehab or capitalizing on that Plainfield logistics boom she mentions. Looking for those pockets of growth.
Finding the next hot neighborhood.
Kind of. And finally, rigorously stress testing the deal. What happens if interest rates spike? What if vacancy increases more than expected? Running downside scenarios to see if the deal still holds up.
Prepare for bumps in the road.
You have to. And related to that, she's very clear about understanding the specific risks involved with 506B and Indy.
Right, we touched on them, but worth reiterating.
Definitely. Illiquidity is number one. Your money is tied up. Sponsor risk, the risk that the people running the deal underperform, or worse. Market risk, what if the Indianapolis economy takes a downturn, or that specific submarket softens? And compliance risk, the risk that the sponsor messes up the 506B rules, potentially causing big problems.
So eyes wide open about the potential downsides.
Absolutely. Thorough preparation, deep due diligence, and good advice are your best defenses. Again, maybe leveraging local expertise.
Okay. Cara Conde's guide also had that Q&A section hitting some common questions. Can we quickly run through those highlights? PAAs, people also ask style.
Sure. A big one is always the difference between 506B and 506C.
G difference.
506B. No public advertising, can include up to 35 sophisticated non-accredited investors. 506C allows public advertising, general solicitation, but only accredited investors can participate, and the sponsor has to take extra steps to verify their accredited status.
Okay, clear distinction. What else?
Qualifications for accredited and sophisticated investors, we covered those income at worth tests and the financial savvy requirement. How to find these deals in Indy? She suggests things like local real estate investment association, REIA meetups, getting on syndicators' private email lists, and again, networking heavily, maybe connecting through people like her.
Makes sense. It's about getting into the right circles.
Exactly. Primary risks, we just hit those. Illiquidity, sponsor, market, compliance. Mitigation is key. Can 5A6B be used for smaller deals? Yes, absolutely. But she notes the fixed costs of setting up the legal structure might make it more cost-effective for slightly larger deals sometimes.
Economy of scale.
Kind of. Typical time frame to close a deal could be 60, 90 days, maybe faster if the sponsor is experienced and has investors lined up. And typical returns. She gives ranges, but emphasizes it varies hugely by deal type and risk cash flow. IRR targets we mentioned earlier might be typical goals for certain Indy projects.
Okay, that's a good rapid fire round. So let's try and wrap this up. Based on Cara Conde's perspective that we've explored, what's the single most important takeaway about Regulation 506B and investing in Indianapolis commercial real estate?
I think the main takeaway is that 506B offers this really significant private pathway, a way to access potentially lucrative commercial real estate deals in Indianapolis that aren't available in the public market.
A private route to potential wealth creation.
Yeah, exactly. And it's but it demands a real understanding. You have to get the mechanics of 506B, weigh the benefits against the very real risks, and crucially, understand the specific dynamics of the Indianapolis market itself.
It's not a passive investment necessarily, requires engagement and knowledge.
Definitely. It's a powerful tool, as Cara Conde underscores, but you need to know how to wield it, especially within the context of Indy's unique market and relational culture. Local knowledge seems key.
Absolutely. So a final thought for our listeners to chew on. As you think about all this, maybe consider, what kind of commercial real estate project here in Indianapolis could align with your own goals, perhaps using a 506B structure? Or, if you're not ready to invest, how could you start strategically building those crucial relationships within the Indy real estate community today?
Good questions to ponder.
It's definitely a fascinating space, and hopefully this deep dive, drawing on Cara Conde's insights, has given everyone some valuable things to think about.